Someone lied to you about investing, and that lie has probably already cost you thousands of dollars, maybe tens of thousands, without you even realizing it. The lie is simple. You need a lot of money to start investing. You've heard it. Maybe you've said it yourself. I'll start investing when I have more money. I'll wait until I have at least $1,000 saved up. Investing is for rich people. Here's the truth nobody tells you. 73% of Americans say they don't invest because they think they can't afford it. 73%. Nearly 3 out of 4 people sitting on the sidelines. Not because the market is closed to them, but because they believe a story that was never true. Let that number sink in. 73%. And while those 73% are waiting for the right time or the right amount, the people who started with $100, just $100, are watching their money grow. Month after month, year after year. Quietly, automatically. You don't need to be rich to invest. You need to invest to get rich. And today, I'm going to show you exactly how to do it. Starting with the $100 you probably already have. I've spent years studying how ordinary people build real wealth. Not lottery winners, not tech founders. Regular people, teachers, nurses, warehouse workers, who figured out one thing everyone else missed. The barrier to investing has never been money. It's always been information. And here's what I want you to understand before we go any further. Most people will watch this and do nothing. They'll nod along, think, that's interesting, and go back to their exact same routine tomorrow. But if you implement even one of these 5 strategies, just one, you will be ahead of the majority of Americans by next week. Some of what I'm about to share will contradict what you've been taught. Some of it will make you a little uncomfortable. That's okay. Discomfort is where change lives. You don't need to do all 5 of these today. Pick one that resonates. Start there. Build the habit. Then add another. The goal isn't perfection. The goal is starting. Because here's what I know for certain. The best investment you will ever make is the one you actually make. Not the one you plan, not the one you research for 6 months, the one you actually do. Let's start with number 1. Let's start with. Most people think buying stocks means buying a whole share. And for a long time, that was true. If you wanted one share of Amazon, you needed over $3,000. One share of Google? Nearly $2,800. One share of Tesla on a good day? Still over $200. So people looked at those numbers and gave up. That's not for me. But something changed, and most people still don't know about it. It's called fractional shares, and it completely rewrote the rules. Here's how it works. Instead of buying a whole share of a company, you buy a fraction of one. You put in $100 and you own a piece, a real, legal, dividend-earning piece, of some of the most powerful companies on the planet. $100 into an S&P 500 index fund today means you own a tiny slice of Apple, a tiny slice of Microsoft, a tiny slice of Nvidia, Visa, Johnson & Johnson, and 496 other companies, all of them with $100. Now let's talk about why that actually matters. The S&P 500 has returned an average of 10.7% per year over the last 30 years. Not every year. Some years it drops, some years it soars. But on average, over time, 10.7%. Here's what that means in real dollars. You invest $100 today and never touch it. In 10 years, at that average return, you have $276. In 20 years, $758. In 30 years, $2,078. You turned $100 into $2,078 without doing anything, without picking stocks, without watching charts, without becoming a finance expert. Now imagine you don't just invest $100 once. Imagine you invest $100 every single month. After 20 years, you'd have approximately $76,000. After 30 years, over $226,000 from $100 a month. That's less than most people spend on subscriptions they forgot they have. But here's the part most people miss, and this is important. 2 people, same age, same income, same $100 a month. Person A starts at 25. Person B waits until 35. Just a 10-year difference. By the time they both hit 65, person A has $637,000. Person B has $227,000. The gap between them is $410,000. Not because person A was smarter, not because they earned more, simply because they started 10 years, $410,000. Let that sink in. So where do you actually do this? Fidelity, Schwab, and Vanguard all offer fractional shares with zero commission. You open an account in about 15 minutes. You search for a fund that tracks the S&P 500, VOO, FSKAX, or SWTSX are solid options. You put in $100, and you're in the market. That's it. That's the whole move. Now I'll come back to something important about taxes in a moment, because where you hold these investments matters almost as much as what you invest in. But first, let's talk about something most financial advisors skip entirely. I know what you're thinking. A savings account isn't investing. And technically, you're right. But here's what I've learned after studying how people actually build wealth versus how they think they build wealth. The ones who skip this step almost always fail. Not because they picked bad investments, because they had no foundation. Here's what happens without a financial foundation. You invest your $100. Markets dip, and they always dip at some point. Your car breaks down, your landlord raises the rent, a medical bill shows up, and suddenly you need that money. So you sell. You pull out of the market at exactly the wrong time. You lock in your losses, and you walk away thinking investing doesn't work. It didn't fail you. You failed the setup. This is where a high-yield savings account, what people call an HYSA, changes everything. A regular savings account at a traditional bank right now pays you somewhere around 0.46% interest per year. That's not a typo. 0.46%. You put $10,000 in there for a full year and you earn $46. Meanwhile, inflation is quietly eating your purchasing power alive. A high-yield savings account at an online bank, right now, many are paying between 4.5% and 5.1% annually. Same $10,000. Same 1 year. You earn $510 instead of $46. That's $464 of free money that most Americans are leaving on the table every single year, just because they never switched accounts. And this isn't complicated. Banks like Marcus by Goldman Sachs, Ally, and SoFi offer HISAs with no minimum balance and no monthly fees. You can open one today with $1. Some people open one with $100 and treat it as their emergency starter fund. Here's the strategy that actually works. Before you invest aggressively, build 1 month of expenses in your HYSA. Just 1 month. Not 6. Not 3. 1. That single cushion changes how you make every financial decision going forward. Think about what that means psychologically. Without savings, every unexpected expense is a crisis. Every crisis creates panic. Panic creates bad decisions. Bad decisions create debt. Debt creates stress. Stress creates more bad decisions. It's a cycle that keeps millions of Americans trapped. With even 1 month saved, an unexpected expense becomes an inconvenience, not a catastrophe. You handle it, you rebuild, you move forward. Your investments stay untouched. The compounding continues. Person A has $100 invested and zero savings. Car breaks down, sells investments, pays a penalty, loses compounding momentum. Person B has $100 invested and $800 in an HYSA. Car breaks down, pulls from savings, rebuilds over 60 days, investments never touched. 5 years later, person B has $9,400 more in their investment account. Not because they earned more, because they never had to stop. Your HYSA isn't an investment. Stop treating it like one. It's your financial shock absorber. It's what keeps your real investments alive long enough to actually work. And right now, while you're earning 4.5% on your emergency fund, that money is still growing. It's not sitting idle, it's working at a rate most Americans' investments weren't even hitting a few years ago. But that's not even the most powerful account I'm going to show you today. Because the next one? The government actually helps you get rich with this one. And 57% of Americans are completely ignoring it. Let me tell you about the single most powerful investing tool available to everyday Americans. It's not a secret hedge fund. It's not a complicated derivative strategy. It's not something reserved for people with financial advisors and six-figure salaries. It's a Roth IRA, and 57% of Americans either don't have one or have no idea how it works. That number should make you angry, because this account is one of the greatest wealth-building gifts the U.S. government has ever created for ordinary people. And most people are walking right past it. Here's what makes it different from everything else. When you invest in a regular brokerage account, you pay taxes on your gains. Every year. Dividends taxed. Capital gains taxed. When you finally sell and take your money out, taxed again. The government takes a cut at almost every step. Inside a Roth IRA, you invest with money you've already paid taxes on, and then this is the part that should stop you in your tracks. Everything that grows inside that account is yours, forever, tax-free. When you retire and pull that money out, you owe the government nothing. Zero. Not a single dollar. Let's put that in real numbers. You invest $100 a month into a regular brokerage account starting at age 25. By age 65, assuming that 10.7% average return, you've accumulated roughly $637,000. But after capital gains taxes, you're walking away with somewhere around $510,000. Now you do the exact same thing inside a Roth IRA. Same $100 a month, same return, same 40 years. You still have $637,000, but this time, you keep all of it, every single dollar, because you already paid taxes up front, back when your contributions were small. The difference is $127,000, just from choosing the right account. And here's what most people don't realize about the Roth IRA contribution rules. You can contribute up to $7,000 per year in 2024 if you're under 50. That's $583 a month. But you can start with way less. There's no minimum contribution. You can put in $25, you can put in $100, you can put in whatever you have. The IRS doesn't care how small you start, they just care that you start. Now here's a contrarian take that might surprise you. Most people obsess over which stocks to pick inside their Roth IRA. They spend hours researching individual companies, trying to find the next Apple, the next Amazon, and almost all of them underperform the market. You know what beats 92% of professional fund managers over a 20-year period? A simple S&P 500 index fund is sitting inside a Roth IRA. That's it. No stock picking, no market timing, no financial genius required. 92% of professionals. Beaten by doing almost nothing. There is one catch worth knowing. The Roth IRA has income limits. If you're single and earn more than $161,000 a year, your ability to contribute starts to phase out. If you earn over $176,000, you can't contribute directly at all. But here's the thing, if you're watching a video about investing with $100, you're almost certainly well within the income limits. This account was built for you. Opening a Roth IRA takes about 20 minutes. Fidelity and Schwab both allow you to open one with no minimum balance. You link your bank account. You set up a $100 automatic monthly contribution. You put it in an S&P 500 index fund, and then you do the hardest thing in investing. You leave it alone. I'll come back to why leaving it alone is harder than it sounds, and why most people can't do it. But first, let's talk about how to actually buy into the market without paying a single dollar in fees, because this next one changed everything for a generation of new investors. Not long ago, buying investments cost money. Every single trade. Every time you bought a share, you paid a commission. $4.95, $6.95. Sometimes $9.95 per transaction. It sounds small. But when you're starting with $100, a $7 commission means you've already lost 7% before the market even opens. That was the hidden tax on small investors, and it kept millions of people out of the market for decades. Then something changed the entire industry overnight. In October 2019, Charles Schwab announced they were dropping trading commissions to zero. Within 24 hours, Fidelity followed. Then TD Ameritrade, then E-Trade. The entire model collapsed in less than a week. Today, you can buy and sell investments on the biggest platforms in America without paying a single cent in commissions. Zero. Every dollar you invest goes directly to work. This is where ETFs come in. And if you don't know what an ETF is, this is the most important definition you'll learn today. ETF stands for Exchange Traded Fund. Think of it like a basket. Inside that basket are dozens, hundreds, sometimes thousands of different stocks. When you buy one share of an ETF, you're buying a piece of that entire basket. One purchase. Instant diversification. Dramatically lower risk than buying individual stocks. Here's a real example. QQQ is an ETF that tracks the 100 largest companies on the NASDAQ. Apple, Microsoft, Nvidia, Meta, Amazon, all in one fund. One share of QQQ costs around $480 right now. But with fractional shares on Fidelity or Schwab, you can own a piece of QQQ for $100. for $50, for $10. VTI is another one worth knowing. It tracks the entire US stock market, not just the top 500 companies. The entire market, over 3,500 companies. One fund, $100 gets you in. Now here's where most new investors make a critical mistake. They download a commission-free app and treat it like a casino. They buy a stock. It goes up 3%. They feel smart. They buy more. It drops 8%. They panic. They sell. They buy something else. They repeat the cycle. 6 months later, they've made 47 trades, paid nothing in commissions, and lost 23% of their money. The tool isn't the problem. The behavior is. Commission-free apps remove the financial barrier to investing. But they accidentally created a behavioral trap. When buying and selling costs nothing, it feels like it means nothing. And that's exactly when it costs you everything. Here's the discipline that actually works. You pick one or two broad ETFs. You set up automatic investments on a fixed schedule. Every week, every 2 weeks, every month. You do not check the price daily. You do not sell when the market drops. You treat it like a bill you pay to your future self. That's it. That's the strategy that builds wealth. Let me show you what that looks like in real numbers. 2 people download the same commission-free app on the same day with the same $100. Person A sets up a $100 automatic monthly investment into VTI and never touches it. Person B actively trades, buys and sells based on news, gut feelings, and Reddit threads. Makes 60 trades in a year. After 10 years, Person A has approximately $20,800. Person B, despite all that activity, has $11,200. The gap is $9,600. Not because Person B picked bad stocks, because they couldn't leave it alone. The single most dangerous feature of commission-free investing is how easy it makes it to do the wrong thing. Use these platforms. They are genuinely powerful, but use them like a boring automatic set-it-and-forget-it machine. Not like a game. And speaking of automation, the 5th way to invest with $100 takes that concept even further. It's the one strategy designed specifically for people who think they don't have enough money, enough time, or enough discipline to invest. Here's the most common excuse I hear about investing. I would invest, but I never have anything left over at the end of the month. Micro-investing apps were built specifically for this problem. Here's how they work. You connect the app to your debit or credit card. Every time you make a purchase, the app rounds up to the nearest dollar and automatically invests the difference. You buy a coffee for $3.60. The app rounds up to $4 and invests 40 cents. Small numbers, but they add up faster than you think. The average Acorns user invests around $30 to $35 per month just from roundups alone, without thinking about it, without budgeting for it, without feeling it. $30 a month at a 10% average annual return. After 30 years, you have $67,900. From your coffee purchases, from your grocery runs, from money you were already spending anyway. Now, I want to be honest with you about something. Micro-investing apps are not going to make you rich by themselves. Acorns charges $3 a month. If you're only investing $30 a month, that fee is 10% of your investment. That's too high. So here's how to use them correctly. Use them to build the habit. 6 months, 12 months, until investing feels automatic and normal. Then graduate into a Roth IRA or a commission-free brokerage where fees are essentially zero. Use the app as your training wheels, not your finish line. Because what these apps really sell isn't returns, it's identity. Every time you see that balance grow, even by $12, your brain starts to see itself differently. You stop being someone who can't invest. You start being someone who does. And that identity shift ripples into every financial decision you make for the rest of your life. Remember that number from the beginning, 73%. 73% of Americans not investing because they believe they can't afford it. Not because the market is closed, not because the tools don't exist, because of a belief, a story, a lie that someone told them a long time ago and they never stopped to question it. You just spent the last few minutes learning 5 ways to invest with exactly $100. Fractional shares and index funds, a high-yield savings account as your foundation, a Roth IRA growing tax-free for decades, commission-free ETFs on platforms that cost you nothing to use, and micro-investing apps that build the habit before you even feel it. None of these required a financial advisor. None required a six-figure salary. None required anything except the decision to start. Here's what I want you to understand. The person you are 5 years from now will be shaped entirely by the habits you build today. Not the habits you plan to build, the ones you actually build. Starting now, every $100 you invest is a vote for the future version of yourself. The one who negotiates from confidence instead of desperation. The one who makes financial decisions from choice instead of fear. The one who stopped waiting for permission to start. You were never waiting for more money. You were waiting for proof that it was possible. Now you have it. You now know something that 73% of Americans don't act on. The market isn't waiting for you to have more money. The tools are already there. The accounts are already open. The minimum is already $100. The only thing that was ever missing was the decision. Pick one of these 5 today. Just one. Open the account. Make the first transfer. Do it before you talk yourself out of it. The best time to start was 10 years ago. The second best time is right now.